how to buy term and invest the difference totally income tax free. I'm Doug Andrew, and this episode will show you that if you understand math and the cost of term insurance and investing the difference and being loyal to that, you're actually better off to do it under the tax-free umbrella, because when E.F. Hutton came up with the idea of universal life back in 1980, it was simply buying term insurance and investing the difference under a tax-free umbrella. And I'm going to go through the numbers with you in this episode to help you understand this concept, so get ready. So I'm Doug Andrew. I've been a financial strategist and retirement planning specialist now for 5 decades, helping thousands of Americans optimize their assets, minimize taxes, and empower what I call their true or authentic wealth. Now, I have helped many thousands of Americans understand how to more or less buy term insurance and invest the difference totally tax-free, and how to become self-insured in as soon as 10 years. So stay with me to understand this, because there's a lot of simpletons out there that just pound that key. No, buy term insurance and invest the difference. That's better than universal life or index universal life. Well, they don't understand that all life insurance has a term insurance component to it. Yes, I started in 1974. I'm an old geezer, been around the block. I might have a Apple Watch on right now, but my first watch was a sundial, and my first pet was a dinosaur. That's how old I am. And so in 1974, I think I was one of the nation's biggest buy term invest the difference proponents out there. I debated this on college campuses and finance classes with professors, and we would fill up auditoriums with thousands of students and what have you. And back then, I was usually debating buy term invest the difference compared to whole life insurance. And if you did discipline yourself to buy term insurance and invested the difference, and I'm talking about annual renewable term, and you invested the difference, even though that term insurance gets more expensive as you get older, if you invested the difference, that's the big if, and you earn rates of return back then of 6%, 8%, 10%, 12%, you would outperform whole life insurance back then, okay? Because whole life insurance was designed primarily for guarantees with death benefit. And if you could earn 8% on whole life, you'll net cash on cash by age 95, maybe just under 6%. And so if we bought term and invested the difference, normally we could outperform it, assuming you invested the difference. Now, there's a lot of people that don't end up disciplining themselves, and so it would be better off to have a forced savings. Well, that's what whole life insurance was. It was called a forced savings account, but the rate of return wasn't, that great. But that's why E.F. Hutton came out with buy term invest the difference tax-free, where you're doing the opposite. Instead of trying to get the most insurance or the amount of insurance you want for the least premium, you're doing the opposite. You're getting the least amount of insurance the IRS will let you get away with, and you're putting in the most money the IRS allows as fast as they allow, and it turns into a tax-free cash cow. So let me try to simplify this for you. All insurance, whether it's permanent, whole life, universal life, or term, is really just pure insurance cost. The risk or the cost of the chance of you dying. That's called the mortality cost or mortality table. And so through my experience, when I first started in 1974, they were still using the 1958 Commissioner's Standard Ordinary. That is called a CSO, Commissioner's Standard Ordinary Mortality Table, 1958. And then they updated it in 1980. And then again, I think in 2001. And, I think the most recent one that most insurance companies is 2021, and then they even tweak it. The actuaries with insurance companies always calculate what is the pure cost of the risk, okay? So let me simplify this. It doesn't matter if I look at the 1958 mortality table, okay? Back in 1958, out of 1,000 30-year-olds in America, there were 2.13 deaths per thousand. By the 1980 mortality table, it reduced to 1.93. Well, now you look at the current one, and there is 1.5 deaths per thousand because, we're taking better care of ourselves, generally speaking. Now, that's 30 years old, but this particular mortality table here shows that for a healthy 30-year-old, well, that's going to go up 1.6, in other words, deaths per thousand the next year, and then 2.1, then 2.4, then 2.7, and then 3 out of 1,000. So the older you get, the more are dying off at that age. Does that make sense? And so let's say you were putting your money in a fraternal organization, and you had 1,000 30-year-olds in this fraternity. And you want to have a $1,000 death benefit for the two winners at the end of the year. When I say that, it's tongue in cheek. The two beneficiaries, the widows, let's say, of these 30-year-old males that will die that year because there's going to be 2 deaths out of 1,000. You pass around the hat, everybody would have to contribute $2 in the hat to come up with $2,000 to pay out 1,000 to each of the two beneficiaries for the two people that died. Does that make sense? That is the pure mortality cost. And so you go to a 60-year-old, and a 60-year-old today, out of every 1,000 60-year-olds that made it to age 60, there's going to be 11.6 die that year, okay? Now, back in 1958, the 60-year-olds, there were 15 and a half, and most actuaries count that there's going to be probably 25 out of 1,000 60-year-olds will die this year. Okay, so hopefully you're getting that is the pure chance or the risk that an insurance company is going to have to pay out a benefit. So let's go back and keep this simple. Let's say you're 30 and you want to be responsible as a husband and a father so that if you happen to die in an accident, which is more likely the cause of death earlier, but you'd be surprised how many get cancer even in their 30s. So you want to leave behind what would have sustained your family had you lived longer. And so it's what we call human life value, what you would have earned had you stayed around. Let's just simplify it. You could add up how much you would have earned for the next 30 or 40 years, but hopefully your children are going to be out of the nest and the need maybe it won't be greater, but with inflation it is. But let's say that you want $1 million of life insurance so that if you die, that $1 million, if it could conservatively earn 7%, that would generate $70,000 a year. And if that equals what your current income is, that might be the minimum amount of life insurance you ought to get is $1 million. So that if you died, $1 million could generate $70,000 a year and keep your spouse, your children with music lessons and what have you, okay? Now, if you want to pay off debts and mortgages and things like that, then you need more coverage. And most people are underinsured, but let's just use this example of $1 million of death benefit. Now, a 30-year-old, the pure mortality cost is what? $2 per thousand. So to get $1 million of life insurance, that's a million is 1,000 thousands. So you're going to have to pay 1,000 times $2. You're going to have to pay $2,000, not a month, a year. So $1 million of life insurance, the pure mortality cost would be $2,000. Well, let's say that you're 30 and you're trying to save, $12,000 a year. Will you be responsible in case you don't stick around to save the money? You allocate $2,000 for term insurance. Well, you should be investing the difference of $10,000. Well, let's just think about this. You only have $10,000 left to earn a rate of return. And let's say your rate of return is 8%. So you can invest the difference and earn 8%, but you only have $10,000 a year. You don't have $12,000 a year earning 8%. And so you'll earn a certain amount of money and it'll grow. But at the end of the day, maybe $10,000 a year may take 20, 25, 30 years to grow to $1 million. But if it's in a tax-deferred IRA or 401k, that $1 million is not all your money. Only $600,000 or $700,000 of it is your money. So you have to take into consideration the tax. Why would you buy term insurance and invest the difference and have to end up with $1.5 million to net $1 million after tax when if you invested in an indexed universal life, I can show you how to rebalance and how I've earned 11 and netted 10 cash on cash in IUL. And so rather than trying to earn 10 or 11 in a mutual fund or an IRA or 401k, I'd have to earn 15% in an IRA or 401k in a portfolio of mutual funds. That's pretty risky to try to earn 15 to net 10 after tax in a 33% bracket. I don't want to go through that. It's too risky. In a max funded IUL, I can earn 11 and net 10, and that 1% difference isn't taxed. It's the cost of the insurance. It's the actual cost of insurance the IRS says has to be there in order for it to be tax-free, because it's tax-free. But if I'm netting 10, I'm going to end up with $1 million nest egg, okay? Because that $1 million nest egg I'm going to end up with sooner, but it's totally tax-free. So if I'm socking away $12,000 a year into an IUL, and that $12,000 a year is growing at a net internal rate of return of 10% tax-free, people say, well, what's the cost of the insurance? I said, doesn't matter, it's included. In other words, the full $12,000 is growing, and when I quote 10% rate of return, that's your net internal rate of return. And if you earn 10, your money's going to double every 7.2 years. If you only earn 9.6%, okay, it's going to double every 7.5 years. Now, if you do the math, this is what you'll find. In an example like this, could you buy term insurance for $2,000, but next year it's going to be a little more. But if you invested the difference, and the difference will be a little bit less, you did that for 30 years, you're going to have a hard time equaling what an IUL will grow to at a net internal rate of return of 10%. And you can watch episodes on this channel to see how to do that by rebalancing. Earning 10%, and when I quote 10%, that's on the full $12,000 in this example. We're not taking $2,000 out for the cost of the insurance. The cost of the insurance is included. You're earning an internal rate of return on the full $12,000. When you buy term and invest the difference, you're only getting the rate of return on the difference of a net of $10,000 the first year. But in a few years, it's only going to be on $9,000 difference, and then $8,000 difference, because the cost of insurance is going to keep going up. Is this making sense? This is what E.F. Hutton came up with back in 1980. They just said, why don't we just buy term and invest the difference, and we'll end up better off, and it's totally tax-free. So if this is intriguing you, I would recommend you do the math and you study and you see actual examples of this and compare it to what if you bought term insurance from age 30 to age 60 or 65, and you actually invested the difference and got what rate of return would you have to get to equal what the same amount of money in the entire plan, the insurance and the savings, the investment, would grow to in an IUL. And you're going to be blown away if the IUL is structured correctly and funded properly. So if you want to learn how to do that, I would strongly recommend you study my book, The Laser Fund, How to Diversify and Create the Foundation for a Tax-Free Retirement. You'll learn in here that most of our clients end up with having their investment inside the insurance, the investing the difference, that will grow to equal and exceed the death benefit, usually within 10 to 15 years. Now, there is no cost of insurance. You are self-insured is what we call it. This is like buy term, invest the difference on steroids. So if you are going, golly, sounds reasonable, but I don't know if I believe that guy, study. So either go to laserfund.com or click on the link below. And if you decide to go to Amazon, this book retails for between $20 up to $60. If you buy it on Amazon, thank you, but I'll give you a copy free. To claim your free copy of this 300-page book, simply go to laserfund.com and contribute a nominal amount towards the shipping and handling. I'll cover the rest of that cost, and I'll pay for the book. I'll fire out a hard copy to you of this 300-page book via priority mail. And if you like to listen and learn or watch and learn, there's options there for that. But this is actually 2 books in one. This side is 200 pages, 14 chapters with all the charts and graphs if you're a left-brain learner. If you like all these numbers. But if you learn more by stories and examples, you can flip it over to this one. This is 12 chapters with 62 actual client stories. If you want to use your whole brain, you can read the left brain and the right brain part of this book. But folks, while you're in there claiming your free copy, if you want to talk to a professional IUL specialist that can show you how to do what I've been talking about, because the vast majority of IUL out there is not structured to do what I've been talking about in this episode. To have the cost of the insurance get cheaper as you get older because you're self-insuring. Have you ever seen a life insurance policy that gets cheaper as you get older, and within 10 or 15 years, there is no cost of the insurance? It's all your money now. Your money has grown to equal the death benefit. Most buy-term invest the difference proponents, it takes 30 to 35 years before investing the difference grows to equal the insurance. You can do that in 10 to 15 years with a properly structured IUL. So you can talk to an IUL specialist and see some illustrations on how these strategies may apply in your particular set of circumstances. This is to you and your brighter future.